Welcome back to WhiteBoard Finance. My name is Marco and I'm here to help you master your money and build your wealth. If you're interested in the stock market, personal finance, entrepreneurship, or real estate investing, this is definitely the channel to subscribe to. If you haven't done already, please hit subscribe and the little bell notification. A lot of my viewers are asking me if the stock market is in a bubble in 2018, and I'd like to address that in this video. Stay tuned. The stock market is at record highs and we've been in a 9-year bull run, so it only feels right to ask if we're in a bubble. This video is not your typical clickbait, fear-mongering, economic collapse, everyone's gonna die kind of video. This video is a high-level overview with some metrics and mostly trend patterns that go over the big picture. So what I want to do is I want to start with trend patterns of previous bubbles and get into the numbers a bit later on. So without further ado, let's get into it right now. I would like to start by talking about the 3 phases of a bull market. So as I mentioned in the intro of this video, we've been on a 9-year bull market run since early 2009. So the first phase of a bull market is the accumulation phase. The second is the public participation phase, and the third is the excess phase. The accumulation phase is the start of the upward trend. So this is when smart money and big investors are starting to get back into the market after a significant downtrend. So this comes at the end of a downtrend similar to 2009, where the prices were super low and those smart money investors know that they have really low risk or a low entry point to those stocks and those prices. So take a look at this screenshot. The higher lows suggest that the trend is now moving upwards, aka an uptrend. So this is what an accumulation phase looks like. The second phase is the public participation phase. During this phase, negative sentiment tends to go away and business conditions improve as good news spreads. So ultimately, more and more investors are getting back into the market because of the conditions, and that ultimately sends the prices higher. This phase is not only the longest lasting typically, but it's also seeing the largest price movement across the board. So take a look at this screenshot. You can see here in the public participation phase, this is when traders start to take long positions and you can see the price increasing over time. The third phase is the excess phase. As the market gets stronger over time, we get into this phase right here. At this point, the market is considered hot by all investors, aka right now, 2018. Smart money starts to scale back their positions, and if you take a look at this screenshot, at this point the market is marked by irrational exuberance or the perception that everything is running great and only good things lie ahead. So I wanted to show you this picture right here. This is a snapshot over the last 9 years. So where do you think we're currently at out of these 3 phases? Are we in the first phase, the second phase, or the third phase? To me, it seems obvious that we're in the excess phase. Would you agree? Now that we've talked a little bit about the phases of a bull market and the big overall macro trend pattern recognitions, I actually want to talk about one of the most important ratios that you've probably never heard of. This ratio is called the CAPE ratio. The CAPE ratio stands for Cyclically Adjusted Price to Earnings Ratio, which was made popular by Nobel Prize-winning economist Robert Shiller. CAPE is calculated by taking the price of the S&P 500 and dividing it by the average of 10 years worth of earnings. So when CAPE is above its long-term average, some would say that the stock market is overvalued or overpriced, and for lack of a better term, I call it expensive to get into these stocks. And when CAPE is nearing historic highs, just like it is right now, some would say that the stock market is on the brink of a crash. Currently, the CAPE ratio is hovering right around 29x, which is substantially above its long-term average of right around 15. So if you can see in this screenshot, you can see that it's almost perfectly predicted the 2000s dot-com bubble bursting and multiple bubbles before that. You have 1966 and also 1929, which was known as Black Tuesday. CAPE is certainly not a perfect ratio, but it seems to predict big overarching trends over the course of time, as you can see in the previous screenshot. So ultimately, like I said, this is not a crystal ball, but you have to give it a second look, you guys. It's been pretty accurate over time. I make my videos quick and concise for a reason. This was just to spark your interest and have you do your own due diligence. I didn't make this video to scare you away from investing, and I certainly don't want you trying to time the market. That's probably the easiest way to miss out on earnings and actually lose money. This is simply to raise the question, is the stock market in a bubble in 2018? And I would love to hear your comments below. Again, this channel isn't about clickbait titles or fear-mongering. It's more about thought-provoking content that'll get you to think before you invest and ultimately have you make the smartest decisions. So again, guys, please comment below and let me know what you think about the stock market being in a bubble in 2018. And if you got any value out of this video, please click the subscribe button below and share this video with one friend. I would greatly appreciate it. Thank you so much and have a prosperous day. Hey, Bob, what's going on, man? Nothing much, just recording a video. I was taking a look at your CAPE ratio. It seems like the S&P 500 is pretty high right now. It's right around 29x. Yeah. So what do you recommend doing? Selling everything and moving to the mountains. Running for the woods? Oh, wow, okay. All right, well, I'll give that a second thought. Thanks, Bob. See ya.